Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we have a jam-packed episode with a bunch of different stuff. For starters, the reason why you clicked on the video and the main topic of the video, we're going to go over how I plan to personally outperform the S&P 500 on a going forward basis. Now, there's not necessarily a time horizon on this. I just want to be able to outperform the S&P 500 as long as I'm actively managing the portfolio. So we're going to go over how I personally plan on doing that and what I'm tracking, the key performance indicators of my portfolio to try to determine whether or not we are actually on track with trying to outperform the S&P 500. In addition to that, we're going to be going over the ASML earnings. If you didn't know, ASML is a company that is in my portfolio. It's the smallest holding in the portfolio, but nonetheless, it's a meaningful position that I'm actually looking to add to. So they had their earnings and the stock was down, I think roughly 15, maybe 20% in the past, give or take 2-3 days. So we're going to be taking a look at that. What went wrong? Why is what has fundamentally changed with this business? Whether or not the thesis is on track, and that type of stuff. And at last, we're going to be jumping over to Twitter. I've been posting very frequently about two businesses. One of them's on screen. You guys are looking at it right now, Adyen. And then we have another mystery holding that I have done a video about in the past. So we're going to talk about these two businesses, whether or not I'm thinking of adding it to the portfolio and what I'm looking at with those two. Jumping over to FinChat, which is the main way that I actually track my portfolio. And the reason for that is that it can very neatly in an organized fashion visually represent to me all the different holdings that I have in my portfolio. And more importantly, you are able to input all your different holdings, the average cost basis, how many shares you own, all that type of stuff. It illustrates all these different holdings to you in this like dashboard-like format. And then scrolling down, you're able to see a pie graph of all the different holdings and whatnot. But the key item, and what I absolutely love about this, is that you could actually choose a bunch of different metrics to include, and it actually averages out the weighted average metrics for your portfolio. So for example, if you have two different businesses at 50% each, a PE of 40 and a PE of 20, then your average PE for the entire portfolio would be 30. And it does this with a plethora of different metrics. And so I've already gone ahead and I've chosen a bunch of different metrics that I personally like to track for my own portfolio. And so we can see the weighted average, for example, PE of the companies in my portfolio is 32. And then we could compare that and we could look at the weighted average price to free cash flow of roughly 30 times. So we could see on average that the businesses in my portfolio produce more cash flow than they do earnings, right? So the free cash flow conversion exceeds 100%. And this is evidenced by the free cash flow margins actually exceeding net income margins. So on and so forth. I think you guys get the idea. And so having this feature to play around with and having this information available to me, this actually allows me to be able to directly compare the combined entity that is my portfolio to the combined entity that is the S&P 500. It's very easy to be able to actually locate, for example, PE data on the S&P 500. There's sources like YCharts, Yahoo Finance, Seeking Alpha, so many different websites that will just give you this information for free. So for example, from YCharts, we know that the S&P 500 currently trades at a forward PE of roughly 22 times, which is a stark difference to the 31 times multiple that is the weighted average of my portfolio. But what's important to note about that is that the S&P 500 is probably growing much slower than my portfolio. And again, to prove this to you, we can figure that information out from RBC Capital. They say that the weighted average S&P 500, the combined entity, is expected to grow at about 9 to 11%, give or take, the EPS that is, right? And so going back over to FinChat, we are able to see that on a 2-year forward basis, per year, my portfolio is expected to grow EPS at 25%, right? So again, this is a very stark difference to the S&P 500. So the average business, or I should say the combined entity that is my portfolio, is growing earnings per share at 25% per year on average, right? And the average entity that is my portfolio has a PE of 32. And so I could directly compare and look, okay, would I rather own the S&P 500 at a 32 PE growing at 9%, or my portfolio as it is currently, which has a 32 PE? Sure, it trades at a premium. It trades at a roughly 50% premium to the S&P 500, but at the same time, it's growing earnings per share 2.5 times faster, right? So it's 1.5 times more expensive, but it's growing 2.5 times faster. Now, of course, there is questions of longevity and how long will that growth sustain itself. But I own some world-class businesses. You're looking at Amazon, Salesforce, Google, MasterCard. These are businesses that are essential to the world, and they have very clear runway of growth ahead of them, right? Particularly in the case of something like Google and MasterCard, right? Like these businesses are going to compound for years and years to come. They must exist, right? Particularly in the case of something like MasterCard, right? So these are businesses that have extremely durable business models. They're not cyclical for the most part. They're not cyclical. Cyclical in the traditional sense, right? Like a car company of in good times with low interest rates and whatnot. There's a lot of revenues, a lot of sales, and that type of stuff, right? So these businesses have durable business models that they could compound throughout the years and consistently be able to keep their growth rates. Sure, there's ups and downs in the economy as a whole, but they tend to be all-weather businesses. They tend to push through those challenges and in general do well, right? Of course, all businesses are cyclical to some degree, but yeah, as you can see, the plan with my portfolio and the way I plan to outperform is by owning a basket of businesses that objectively have a wider moat and are more competitively advantaged than the average businesses in the S&P 500. And at the same time, I try to own these businesses at a valuation to growth multiple that exceeds the S&P 500. They're providing to me more growth despite trading at a slightly higher premium to the S&P 500. And that's the strategy. That's how I plan to outperform the S&P 500. And you might be sitting there saying, all right, I don't think the businesses you own have wider moat than the S&P 500. I disagree with that statement. And I could prove you wrong. We could look at very basic things. For example, the margin structure of the businesses in my portfolio. For starters, gross profit margin, which is simply the cost incorporated with actually making the products that these businesses sell. So if they're selling you a t-shirt, what is the actual t-shirt cost? How does it what is the direct cost correlated to making that t-shirt? Not necessarily the freight of getting it in the store or the lights and utility bills of the store, the personnel that are in the store selling the shirts and whatnot, right? Just the direct costs correlated with the shirt, right? And we can take a look at that. The gross profit margin of the average entity that is my portfolio is 65%. This is a stark comparison to the S&P 500, which is roughly 35%, right? So we're roughly double the gross profit margin of the S&P 500. You could do the same exercise with both operating and free cash flow margins. Those are also both around double what the S&P 500 is, right? So the S&P 500 roughly 10%, operating and free cash flow margins of 20% for my portfolio. EBIT to interest expense, this is the interest coverage ratio. Little bit like alien to most investors. I didn't really know what it was until recently as well. It's a very useful ratio to consider. So this simply takes the operating profit of the business, so what you pay, what is remaining in the bank balance before you pay taxes and before you pay interest on your debt, and it divides it by how much interest expense you owe to the bank. Right? And ideally, you'd want this to exceed roughly the 10 to 15 mark, at least according to some sources online. The 10 to 15 mark tends to be a healthy interest coverage ratio. For the businesses in my portfolio, it's 140 times. And the reason for that is that most of these businesses either have a net cash balance or they are producing enough cash flow to be able to cover their interest expense at least this year, or within a few years, be able to cover their debt in its entirety, right? Most of these businesses, I think, actually cover their debt balance. One last thing before we move on here, if you're impressed by the functionalities of FinChat and would like to give it a try for yourself, you could do so absolutely for free with no strings attached using the top link in the description down below. For full functionality of the website with chart data spanning 20 years, you would have to opt in for the premium or pro versions of the website. But basic features like the dashboard and stuff, this is all completely free. You guys could go ahead and use it. Again, using the top link down below. I do make commissions off of that, so just as a heads up, so there's no conflict of interest. Moving a little bit further here, we're going to look at the ASML earnings. And ASML, as I mentioned earlier in the video, it is the smallest holding in my portfolio at roughly 4%. I'm very interested in adding more to this position. Now, I'm sure some of you guys don't really know what ASML does. Long story short, they make these machines called lithography machines, and these are the machines that are built to actually make the chips that exist literally everywhere around me. With the iPhone, I'm recording this on the keyboard that I'm using to type over here, the microphone that is recording my audio. You guys get the point, right? The monitor, the PC, literally everything around us has computer chips and semiconductors in it, right? And ASML makes the machines that are able to print and manufacture all these different machines. Make all these different chips and manufacture all these different chips. They themselves, they don't make the chips, but they make the machines that make the chips, right? So TSMC, Samsung, and Intel, those are the people that actually end up purchasing these different machines from ASML, and those are the guys that end up manufacturing all these different chips for all of us, right? And so very interesting company because it sits at a choke point in the semiconductor industry. This is the only business that has the ability to actually make these very advanced machines for the cutting edge iPhones and the cutting edge laptops, the extremely complex NVIDIA H100 chips that are used to train AI models. All these different chips that are at the cutting edge of just human advancement, I guess, they need ASML's lithography machines, at least the EUV machines, that is, right? There's also DUV machines. Those are for more basic chips, such as like your calculator, your toaster, some car components and that type of stuff, right? So they make both machines that make basic chips and they make machines that make very complex chips, right? And they have a very strong market position in this industry. So ASML reported, I want to say roughly 2-3 days ago, and the stock was down a lot. And honestly, we could even pull up the stock chart here. That's pretty ugly. I mean, just like 5 days ago, this business was at 1,100. It has declined roughly 20% since 5 days ago, right? So you would imagine this is just a disastrous quarter all around, right? That obviously, right? Like, haven't we learned in the plethora of YouTube videos that I've made on earnings that, if the stock is down, that is almost 100% indicative of the fact that the company has fundamentally been shattered in some sense, right? So jumping over to the investor presentation to finally actually look at these earnings, we're able to see right away, the first slide they put right in front of your face, they say we are maintaining the guidance that we issued last year in 2023. And if you didn't know ASML, they said that 2024 would be somewhat of like a down year or like a transition year in some sense. And they expect revenues to just stay flat year over year, but then they expect 2025 to be very strong. And this makes sense. ASML, between all the businesses I own in my portfolio, is the most cyclical business just because it operates in a cyclical industry to begin with, right? The chip industry, the semiconductors, they're very, very cyclical just in general, right? So ASML is not immune to that. And you'll have years where, revenue stays flat year over year, but then that's followed up with like a 35% revenue growth rate in 2025, right? So it's very much up and down in some sense and just stays flat with a big boost afterwards and whatnot. And it doesn't help that, they're selling $300-400 million lithography machines. These machines, there's only a handful of entities in the world that could even afford these things, right? So depending on the timing and development of these machines and when they actually ship them out to, for example, TSMC, Intel, and Samsung and all them, right? Depending on when they ship them out, you'll have timing of cash flows or timing of revenues that is just very random, right? But on like a 3-4 year basis, you should be able to see that this business is going to be growing and growing very comfortably, right? Like the CAGR, the compound annual growth rate figures on like a 3-4, maybe a 5 year time frame, it'll look much better. It'll be more smoothed out, right? So revenue growth rate year over year, they maintain the guidance, and I think a little bit further down here, they actually give you the comparables to the year ago period. I think it went down, but yeah, revenue stayed flat to a little bit down, whatever. They've guided for that, and they've said 2025 would look much better. Gross margins, 52%. This is honestly fine. If you know what, we could actually pull this up if we jump over to FinChat. You could actually look at the historical gross margins of this business over time. And I'm going to put this on annual, and then we're going to go down here to the margins tab and toggle on gross profit margins. Again, you're able to see that since 2014, gross margins have meaningfully ticked up. It seems in 2020, this was a pretty big year between the 2019 to 2021 period. That's when gross margins meaningfully went up. Over time, I do expect margins to expand with ASML just as they unlock more efficiencies internally within their business. Operating margins of 30%. This is incredibly strong. I mean, it's right up there with the premier businesses around the world. I think Google is probably around the same mark, and they literally have like I wouldn't even call it a software, but I mean, they are the gatekeepers on internet access around the world, right? Like, so obviously Google has a very incredibly high margin business. So ASML, they're a hardware company shipping big, massive $400 million lithography machines, somehow have maintained 30% operating margins. Just absolutely incredible stuff from that part of the business. And then net bookings number. So this is a key performance indicator from ASML specifically. This is the amount of revenue that they have in the pipeline that they're expected to get, that they're going to get, but they just haven't shipped the machines out yet, right? So they'll enter contracts with Samsung and TSMC and whatnot, talking about how, you guys are going to buy this machine from us. You have a allocation in this order, right? So for example, TSMC, you get 6 machines first, and then Samsung, and then Intel, whatnot, right? So it's revenue in the pipeline. And actually, again, jumping back over to FinChat, we were able to go to the segment and KPIs section, and we are actually able to put this KPI, and we could see it visually over time. All the way at the bottom here, there is a net bookings figure, and simply toggling that on, you're able to see over time the revenue in the pipeline. So you could see with the chip shortage in 2021 and 2022, TSMC and all these different companies, they were actually paying in advance for services to be provided later, or I guess these machines to be built. They were paying in advance to have their spot saved in line. And over time, it's smoothed out. As you can see, if you were to kind of draw like a line over time, you could see that it's going up and to the right. Over time, ASML is able to increase the amount of revenue they have in their pipeline. Over the past give or take decade, this has grown at roughly 17% compound annual growth rate. Absolutely incredible. This is somewhat a proxy of future revenue, right? So if you see this number growing year over year, for example, at like 17%, you should realistically expect for revenues to grow at roughly the 17% mark, right? Because it's revenue in the pipeline. Over here, they have a couple other slides. I'm not going to go over this, just a revenue breakdown of where exactly they come from. To be honest with you, I don't know what half of these words even mean, but something to look at. I'll link this in the description if you want to check it out for yourself if you're a ASML shareholder. At the end here, they talked about their dividend. Something interesting to note about ASML is they actually don't have a fixed dividend. So they'll just pay out whatever excess cash they have at the end of the year or at the end of the quarter. And it could move up and down, right? You're able to see, for example, in 2024, there's not like a fixed increase that they'll do. There's not like a fixed dividend that they'll be paying. It just kind of whatever. Same thing about share buybacks. They opportunistically give out dividends and share buybacks depending on where the stock is at and whatnot, how the valuation is doing. All the way at the end here, I want to very briefly talk about 2 companies on my watch list, Adyen and Uber. Uber is the second business that I kind of teased at the start of the video. I will do a very in-depth video on Adyen. I think, at least in my research, as I was researching it, of course, I searched for YouTube videos on Adyen. There isn't anything on YouTube that goes very in depth on what it is exactly Adyen does and why it's just a absolutely brilliant business model. There's nothing on it on YouTube. There's, oh, it's a payment gateway, payment processor, they take a transaction fee, settlement fees, blah, blah, whatever. I'm going to do a very in-depth video on that, so stay tuned for that. Long story short, this is like, I would say, personally, in my opinion, this is one step below Visa and MasterCard, both in terms of moat and in terms of just pure business model, right? Of course, MasterCard, Visa are just absolutely untouchable, but Adyen is a business with 60-65% EBITDA margins, which is like a proxy for free cash flows. Again, in the main video, we'll dive into why free cash flows actually doesn't work for Adyen, but just for simplicity's sake, think of 60% free cash flow margin. That's higher than even MasterCard, right? Like if we were to pull up MasterCard over here, free cash flow margins of 45%. It's nowhere near, right? Even operating margins. I think Adyen has 60% operating margins or something ridiculous, right? So incredibly cash generative business, and their management team is incredible, all that type of stuff. Well, I'll do a very in-depth video on that in the coming, give or take, week. So stay tuned for that. Number 2 on the list is Uber. And Uber, the reason why I'm interested in Uber is it's honestly right up my alley of a scale economies driven business in a somewhat winner take all industry dynamic, right? Uber is a very incredible brand, and there's a language moat there as well. And the idea with it is there's a almost fixed cost to operating the app and operating the research and development that goes into the app and all that type of stuff. There's a fixed expense that you have to do developing all that type of stuff over the past, 10, 15 years. And then everything beyond that could be pure profit. Once you have your fixed cost of running the business, you have no variable cost with Uber, right? For example, with a restaurant or a Starbucks or something, you have the variable cost of per unit you sell, per coffee you sell. You have some costs incorporated with that. But with something like an Uber, you create this app and there's a fixed cost of a couple $1 billion per year that you have to dump into that. And it doesn't matter to you if that generates 10 billion in revenue or 50, 60 billion in revenue, because you're going to keep dumping the same amount of money into the app, right? So it's a scale economies driven business. And then on top of that, there's a lot of interesting qualities that comes with Uber. And then on top of that, of course, analyst estimates, especially for Uber, which is a very uncertain business to begin with, very uncertain industry dynamic. On top of that, analyst estimates should be taken with the biggest grain of salt exists on earth. But nonetheless, you guys might notice 46% earnings per share growth for the next 3 to 5 years is just ridiculous. I mean, this is in at least large scale businesses, this is one of the highest growth rates I've seen. Okay, Nvidia, right? But barring Nvidia, in large scale businesses, this is one of the higher growth rates I've seen analyzing stocks for like the past give or take year. And honestly, the valuation is not that demanding. Sure, 42 PE, even a forward PE, that's very high, traditionally speaking. But I mean, the growth really does make up for it. But then comes in the question of like, is it going to grow at those growth rates? Is that irrational to expect that type of stuff, right? There's a lot of question marks around what is the long-term margin structure of something like Uber. Of course, the comparison I'd like to make is, for example, something like Amazon that operated at a loss for like over a decade and a half, or even Netflix, which only recently turned profitable, right? So we have these scale economies driven businesses that these internet businesses that operate at a loss for like a decade or 2 decades and whatnot. And then at the end of it, when they reach scale, when their competitors are eradicated, they turn on the profitability switch, and then all of a sudden they're incredibly cash flow generative, right? So Uber kind of fits into that niche of stocks, into the Netflix, the Amazon, the Airbnb type of stocks that I'm very much interested in, because I think most people underestimate the true free cash flow generating power of these businesses, right? So I'm going to do a follow-up stock analysis on Uber and Adyen. I've already done a stock analysis on Uber, which you could check out. I'll put in the corner here. It'll be linked in the description as well if you're interested in that. With that being said, that's all I have for you today. You could feel free to click off the video. I do have some housekeeping items for those of you who are interested on like a personal level. I've been working a lot, hence why the upload schedule hasn't been that great. I plan on uploading roughly 2 videos per week. I think that's a success if I could get that done. Of course, I have just general life stuff that's going on as well. Additionally, I actually got paid today. So I'll be dumping more money probably into MasterCard. I think MasterCard trades at very attractive valuations given the growth profile and the moat that business has. You could go over to my Twitter, also linked in the description, for my full thoughts on that type of stuff. Just search, you could do this actually at the top here. Can you guys see this? Yeah. So you could search my tag at QualityInvest5, followed by the ticker symbol MasterCard, and then you're able to see all the different tweets that I've done on MasterCard, right? So doing this, you can see just my full thoughts, particularly this post here with the value-added services. You guys could take a look of why I chose MasterCard and all that type of stuff. I do plan on eventually, I do plan on eventually doing a very deep video covering MasterCard and all that type of stuff. That's a little bit further down in the pipeline, right? We have the Adyen video, the Uber video, eventually a portfolio update somewhere in there. I might just include it in the portfolio update. That's what I might do. But yeah, got paid, so I'll be dumping most of that into MasterCard. I am, again, considering Adyen and Uber, so we got to do a little bit more research. I do have some glaring problems with each, which will be in the videos. Also, one last thing, if you'd like to give FinChat a try, again, absolutely for free with no strings attached, you could do so using the top link in the description down below. And at last, if you like the fact that I don't waste your time, hit the subscribe button, because I'm going to continue to post high quality videos just like this one. And you can always go back on that decision if you end up not liking the videos, but I highly doubt that. Thank you for watching and have a great day.